This is Paul Donovan from the Global Economics Department. Japan's exports were down. They were down for the most in 7 years. They were down to China for the first time since 2005. They were abruptly down to Asia. They disappointed across the board. The Japanese economy, unlike the rest of the G7, is not facing up to the awful reality of deleveraging. Deleveraging is what the last 18 years have been about for Japan. However, it does have to face up to the cyclical realities of being an economy where exports were the main driver of growth, our investment spending, which was funded out of retained earnings, which was driven by exports. The weak data has given downside risk to fourth quarter GDP estimates for Japan, obviously. It's also a pretty clear signal of downside risks to Asian and indeed global demand. The Bank of England's Gieve clearly signalled the potential for UK rates to come down further. The Bank of England minutes showed discussion of larger rate cuts than the one that we actually got last time, and Gieve said that more rate cuts may well be necessary, as inflation was likely to be down below target in the medium term. Today sees the release of October retail sales from the UK widely expected to be down. The Fed minutes indicated, inevitably, that US rates would come down further. Hardly any surprises there. Growth expectations were down, and some members' expectations for inflation have come down a very long way. It is clear that some members of the FOMC regard deflation as a meaningful risk. For quantitative easing, the minutes indicated that this would be an option as the zero bound on interest rates is approached. The important point here, of course, being that the Fed is saying quantitative easing is something they could do in the future, not something that they are doing at the moment. We've revised down our expectation for the leading indicators from the states which are due for release today. The ECB meets today. If they had any sense of reality, they would be taking rates down. However, today is not supposedly a meeting where they decide interest rates, though that is a convention, not a binding constraint. There are certainly questions about the extent to which the ECB has a grasp on reality as well. And this was the central bank that was raising rates this summer in the face of an utterly non-existent inflation threat, after all. Der Spiegel is suggesting that there is sufficient concern about the downward spiral of the European economy as to prompt a pan-EU fiscal stimulus of 130 billion euros. Of course, that would need more funds from the member states who are all busy pursuing their own agendas on fiscal policy. Europe has not really shown itself to be an effective collective entity throughout this crisis. German producer price inflation is expected to slow down, and Italian industrial orders are forecast down today. Meanwhile, equities are down, S&P equity futures are down, commodities are down, oil is down, bond yields are down, the euro is down, and the dollar is down. The best strategy in the current market environment would be to keep one's head down. That's all for today. Have a good day.